I have divided the subject into government deductions and then employer deductions. And by the way, I don't think we're gonna be here for 45 minutes, because if I talk for 45 minutes, I'm not sure you'd have anything left in your paycheck. So, but anyway, let's talk about the government deductions. There are basically four. The first is the federal income taxes. And when you probably might remember this, but when you first go into a job, they are required to have you fill out something called a W-4 form. Okay, and the W-4 form, it's the questions they ask don't seem to make full sense, but if you fill out that W-4 form, what it's doing is trying to estimate what your taxes are gonna be. And what they do, they take your answers on that form and they match it against some tables. And that's how they determine what needs to come out of your paycheck, so that you are setting aside the right amount for taxes. Now understand, that's not your tax liability. That is an estimate of your tax liability, such that you don't actually know your tax liability until close to April 15th of the following year. And if those estimates that have been made are a little bit high, then you will get a refund. And if they are a little bit low, then you will owe taxes. And the tables are designed such that people will generally get a little bit of a refund back. But again, it's just an estimate, and it's not perfect. There are a couple of situations, well, it won't give you a very good answer. One of those situations, if you're husband and wife, and you have pretty significant differences in your income level. For example, let's say one person is making $50,000 and the other person is making $150,000. Okay, and the reason, so if the person is who's making the lower amount is filling out her card, she's liable to be under withheld. The reason for that is we have a progressive tax system, which means the more that you earn, the largest percentage of taxes that you pay. So someone earning $50,000 when it's combined with their spouse is actually earning, in this case of a spouse earning $150,000, is earning $200,000 at a higher rate. So filling out the tables will tend to not put as much away as you would need. Now, you can correct that once you realize there's a problem by going back and refiling the form, and you have places where you can put away more, because most people like to get at least somewhat of a refund back. Okay. Another area where it can cause problems if you have uneven income during the course of a year. If you're someone that, say, is receiving your salary on a commission basis, and sometimes you have good months and sometimes you have bad months, in those cases, it tends to over withhold, because whatever your pay period is, assuming it's a month time, and if you have a huge payment in a month, it multiplies that by 12 and matches that against the tables for someone that's making that, if you've been making it the whole year. And so it would tend to take out more than that. And if you got it really low, it would then take out little or nothing. But it tends, because of the progressive natures of our taxes, it would tend to over withhold, which means you would have a larger deduction. But again, those problems can be rectified once you realize you have a problem by simply going in and refilling out the W-4 form. Now, something going on this year, and I say this year, we are filing our taxes now for tax year 2018. And there may be a problem with the withholdings of people's checks. And that's because there was a pretty significant change in the tax laws that were announced in the fall of 2017. And basically, for most people, the tax rates were being lowered. And the whole idea is to stimulate the economy, lowering taxes, and people have more money to spend, and that stimulates the economy. So they went to these tables and made an adjustment to try to reflect the new tax rates. And the reason they did that, they didn't want people to have to wait till they filed their taxes this April to get that extra money because of the lower rates. They wanted to put it in their hands right away. Many people feel that they kind of overdid it and they reduced people's, the amount they took out for taxes too much, which means a lot of people may owe more than they expect in April. I don't know if you remember, it was sometime around February of last year when they finally were able to change the tables and reduce the amount of money coming out of people's checks. So there may be a problem this year, and again, if there is, you can go in and adjust your withholdings based on refiling the W-4. So that's the federal income tax. And again, the important thing is it is an estimate of your tax liability. It's not actually your tax liability. You only know that when you file for the year, which of course we're doing now for 2018. Now, the state income taxes is very simple. Most states, not all, pretty much mirror the federal, but they look very similar, only that the deductions and tax rates are different, but the form of the two are very similar. And you fill out a state W-4 just like the federal W-4. But there is a problem this year as well. And that's because when they changed the federal tax returns for 2018, there was some somewhat significant structural changes. And without going into the detail, there were no changes in the Virginia to basically match that structure. And so the net effect of that is that for people making somewhere between $50,000 and $100,000, and it would tend to favor more people that own a home, and that's solidly middle class, they're going to get a tax increase this year because Virginia did not change their tax rules to basically offset or match the changes that the federal did. Now, this was in the, it's been in the paper a little bit over the last year. They knew about it a year ago, and they didn't do anything. I can promise you, with what's going on with our government now, you're not going to hear much about this. But as a matter of fact, I did read, it was either this morning's paper or yesterday's paper, that with all this stuff going on, the General Assembly is still working on this, but they don't know what the outcome's going to be. And they say if they change it so these people don't have an increase in taxes, they may not be able to make it effective till like July 1. And so what do you do because people have already filed their taxes? They haven't answered all those questions. And see, the difficult thing is, and why people are complaining about it, is that it actually represents a tax increase when nobody voted on it. Now, you know, politicians love to get extra money because you know what they like to do with the money they get, and they like to spend it. And so to be able to get more tax revenues and not have to go out and actually vote on it is, you know, they like that. But it's really unfair to those people. And if I had to guess, they're going to do something about it, but I don't know how they're going to solve the fact that people are already filing their Virginia taxes. So that is an interesting aspect in terms of state taxes. Now, let's move on to Social Security. Social Security is basically a retirement program for us all. Now, I know a lot of people in your generation probably think there isn't going to be any Social Security by the time you get there, and I understand those thoughts. I happen to disagree with that, and I'll tell you why in a little bit. First, let me go how it works. Each person has deducted from their paycheck 6.4% for Social Security. Okay, and that's on income up to, it's about 130,000, it might be 130,200, I couldn't remember when I was putting these slides exactly what it was. It changes every year for inflation. And so that is taken out up to wages of 130,000, and on any wages beyond that, it's no longer taken out. And now the interesting thing is that 6.4% comes out of your check, but your employer also has to pay 6.4%. Okay, so a total of 12.8% is actually being set aside for Social Security for you. I say that for you, kind of for you, and which I'll explain in a minute. But one other thing to know about that, if you ever become self-employed, you have to pay the whole thing yourself. So someone who's self-employed has to pay Social Security taxes of 12.8%, because you're paying both the employer and the employee's share of that. Now, the reason I think Social Security is going to be around for you all is that Social Security has two problems, but both of them are easily solvable. Now, our government has to do something about it, and oftentimes they aren't really good at doing stuff, but the Social Security issue is really solvable. And the two problems are this. I represent one of the problems. I was born in 1952, right in the middle of the baby boomers. The baby boomers are generally supposed to have started in 1945 and pretty much ended in 1960. And of course, that was a result of, if you will, the pent-up demand because of the 5 years we were in World War II. And then parents got really active, and so you have a bulge of population for people born in that period. And that population now, I just became full Social Security eligible a year ago. So I'm in the middle of it, and so we're kind of moving through this bulge through the population. Now, the good news is, by the time you all need Social Security benefits, we're going to be long gone, okay? But right now, the projections of this trust fund that holds the money for Social Security, it's supposed to run out in I think projections about 2032. Okay, and so something's going to have to be done to correct that. Okay, that's the first problem. The second problem with Social Security is that Social Security started in 1935, and it was for people that were 65 and older. Would anybody care to wager what the life expectancy was in 1935? Anybody?
70.
Yes? Excuse me?
70.
It was not bad. It's actually 67. So when Social Security started, statistically, you're only covering people for 2 years on average. And so it wasn't that big a deal. Okay? Now what's life expectancy? A lot of people should know that question.
Around 80.
Yeah, it's around 78 for males, I think about 84 for females, but don't forget, people have to die before you collect those statistics. So the people that are currently living will probably live longer than that, so it's what's called a lagging statistic, and you all will probably all hopefully make it well into your 90s and a lot more into your 100s. So people are living longer. So one of the things they have to do is to delay the time period when someone can start Social Security, at least get full benefits. Now, they did this once before. They had this problem back in the early 80s. And so when the original Social Security was set up in 65, starting in 83, they started working on a sliding scale, and depending on your age, it was gradually went up. I happen to be in that group that is actually 66. And over the next 5 years, it's going to move to 67. Okay, and they're probably going to have to enact a law that maybe puts the full retirement age to age 70. Okay, and let's face it, you're going to be living a lot. You don't have to work that long, by the way. And you can also get benefits early. Actually, most people even today get their benefits early. You can get it as early as age 62. You just get an actuarially reduced amount for Social Security. Does that make sense? Okay, then the final one is Medicare. You all will probably be dealing with Medicare your whole lives. That's the giant elephant in the room, by the way. But anyway, you have 1.45% taken out of your paycheck for Medicare. Your employer also has the same amount, and that is likely going to rise in the future because the math doesn't work when we keep expanding what Medicare covers. And so that's probably going to go up over time. But for right now, it's 1.45 for you and 1.45 for the employer. Okay, so when you total all these things up, again, it actually depends on what your income is, because the higher the income, the higher the federal and state, state tax cap out at income is about $20,000, so it's relatively flat. But so if you start out, and let's say you are making somewhere between $50,000 and $100,000, then when you add all these things up, you're probably getting about 25% taken out of your paycheck for taxes. If you're at the upper income level, it's approaching 50%. So it is a pretty big bite. But again, that's the income is the primary way our federal government collects money. And we're constantly demanding more and more out of government, and so it's got to come from somewhere. So that's kind of all the bad news. I want to go to the next page, which is kind of the good news, because that's for you all, and also represents some tax savings. Okay, those are government deductions. The following here are employer deductions. And these vary by employer, so not everyone is going to have all of these. It, again, depends on how big they are and, quite frankly, how sophisticated they are. The good companies will zero in and get the most benefit that they can for their employees, and hopefully someone, it's typically the human resource people, will explain to you how to take advantage of these benefits. Let's go down. The first thing is insurance. And medical, dental, disability. One time they were also offering people long-term care insurance you could get through your employer, although that's gotten prohibitively expensive. And basically, out of your paycheck comes the employee share. I tell you, when I was your all age, I paid almost nothing for it. I mean, I paid maybe less than $100 a month for myself, my whole family. Okay. Now, it wasn't expensive back then, and companies were picking up a much larger percentage of healthcare. But of course, over the last 30, 40 years, the healthcare expenses has gone up, and companies have been less willing to pay the full amount, and so they've been transferring it more to the employees. And so more and more, and you'll see that's going to continue. You'll see more coming out of your paycheck for healthcare costs. It's kind of interesting. Almost everybody gets their insurance through their company. Okay, and when that started, it kind of made sense. In a lot of ways, it doesn't make sense anymore, but we haven't figured out another way to do it. It actually started after World War II, and there were price controls where the government put in to prevent inflation, and so companies were having trouble competing on salary because of price controls. So that's when kind of employee benefits first get started. So, you know, they throw in free health care, free dental care, whatever it took to get the employees they wanted. Okay, and it kind of made sense back then because most people stayed with their same employer throughout their career. But over the last 40 years, that has dramatically changed, and you all will likely change employers 2, 3, 4 times. I'm actually well, I've been self-employed for 25 years, but I worked for 3 different employers before that. And so you run into problems when you change employers because you have to change healthcare plans. Now, there used to be a huge issue with pre-existing conditions where you changed companies. Typically, the new company wouldn't take on any medical expenses if you already incurred it when you were working for the previous company. I ran into that situation one time with one of my children, and I had to keep the old insurance as well as getting into new insurance for the 1 year till that expired. Now, they have done away with pre-existing conditions right now, but anyway, that's just a kind of little history in terms of the employers paying their medical insurance. Now, next thing is retirement savings plans. Okay, and first, let me tell you that if you all were in my class that I'm teaching personal finance, you would learn that at a minimum, you should immediately, when you get into your first professional job, start putting at least 10% of your income into your retirement. A lot of people don't do that, and that's because one of the biases we all have is that near-term things are more important to us than far-term things. And I'm sure none of you all woke up this morning and started thinking about your retirement. We don't do that, okay? Reality is, of all the things you save for, that's the one you're gonna spend the most time enjoying. So it should have a high priority, but because it's so far off, people just tend not to get started. So one of the things, again, I tell my class, and about every third day, I ask them to repeat to me how much they should start when they to kind of ingrain it in their head. So that's a quick thought about that. But you have heard the terms 401k. There's also a 401a, which I think that's what they have here at MCV. 403b, and that's for educators as well. Those all represent the tax codes. In other words, if you go into the IRS tax code and look at section 403b, that's what allows a retirement savings plan. Now, the whole benefit of putting money into a retirement savings plan is that you're not taxed on that money when it goes into it. And oftentimes, your employer will have a match. In other words, whatever you put in, they'll add 50 cents on the dollar. So it's very important for your own, and by the way, their match doesn't count on your 10%. You should get 10% on your dollar. But you don't get their match unless you make the contribution. Now, one of the things that people have recognized that too many people don't start in this thing. So a recent change 2 or 3 years ago was they allowed companies to have a opt-out provision as opposed to an opt-in provision. And what that means is, you go into a company, you're bombarded with filling out your W-4, which health, and you want all those types of things. And here's your 401k, and most people say, I'll think about that later, and they never get to it. So they changed the law, and companies don't have to do it, but most of them are doing it, where when you start working there, you're automatically signed up for a percentage. Now, it's typically not 10%, it's something maybe 4 or 5%. But the whole idea is to get people started in it, and then they have to opt out. They can't force you to do it. But, and again, that's to encourage more people to save in retirement plans. The current maximum contribution for 2019 is $19,000. And that changes every year with inflation. And I say some employers, actually most employers will generally have some sort of a match. So if you don't get into the plan, you don't get the match, so you're saying no thank you to money they're willing to give you if you put it into your retirement plan. So that's something you want to consider. Now, next things are healthcare related. The first is something called a flex spending account. In my recollection, this has been around for 10 or 15 years. The benefit of having a flex spending account, it allows you to pay for things with pre-tax dollars. In other words, part of your salary goes into these plans before it's taxed, and then you can use it. In the case of flex spending accounts, you can use them for child care costs, and you can use them for medical costs. And those medical costs can be any premiums that you're paying. They can be prescriptions. They can be just about anything. The cap for these is $2,700 for 2019. Now, it used to be these things had a provision that you had to use them up in the year you put the money away. In other words, you put $2,700 into a plan, and if you didn't spend it by December 31st, you lost the balance that you had in the plan. So what a lot of people did was move their discretionary medical spending, such as maybe eyeglasses being good that you could easily push off to January if you had run out of money. Or if you hadn't run out of money, you at least buy yourself 2 pairs of glasses as opposed to 1, so that you use up the money, because you did used to lose it. Now, they changed that law 3 or 4 years ago, so I think they give you 90 days into the next year to use it, which is a little bit better flexibility. But again, everybody should take advantage of that, as long as you expect to have $2,700 of either child care or medical expenses, because again, you're able to use pre-tax dollars. And so depending on what your tax bracket is, your money will go 30 or 40% farther by using the flex spending account. And then the next one is a health savings account. Health savings accounts, I think, are a great tool. And they were created, I want to say 10, 15 years ago. They work with a high deductible medical plan. And high deductible plans came into popularity because one of the ways to control healthcare costs is they wanted to have people more involved with paying for their own healthcare. And before you had high deductible plans, a lot of plans you would reach a relatively low deductible of maybe $500, then the healthcare plan would cover all or most of everything else. And so the consumer, which is the employee, which was making healthcare decisions, they didn't care what it cost after that because the insurance company was paying for it, and that's one of the things that was raising the cost. So these high deductible healthcare plans came in where you would have deductibles of, I think my wife and I's was $1,500 for individual and $3,000 for the two of us. And so you had to pay a lot more of the money up front, and with the idea that you'd think a little more before you actually spent those dollars because they were coming out of your pocket. Okay, well, to offset that, by the way, your premiums were lower because of that, but they also then, if it was a high deductible plan, they allowed you to contribute into a health savings account. And I took huge advantage of this. Different from a flex spending account, you can actually accumulate money in a health savings account. And currently, an individual can put $3,500 into it, and family can put $7,000. And it can sit there and accumulate. And my wife and I are fortunately quite healthy. As a matter of fact, I'm now on Medicare. This is my second year on Medicare, but I was probably on a high deductible plan for 8 or 9 years, and only one of those years did I meet my deductible. I just didn't have that many medical expenses. I was fortunately healthy. My wife's the same way. So over time, we've been able to accumulate about $50,000 in one of these accounts. And actually, the sophisticated ones, much like a 401k, we can actually pick investments in. And I tell you, what's interesting, I never did this, but I probably should have. Some of my colleagues, the financial advisors, were putting money in these things, and when they had covered healthcare expenses, they didn't use it. They just paid them out of pocket. And they said, why not just let this continue growing tax-free and just create a huge nest egg for the future? I actually didn't do that. I never took much out of them, but I did take medical expense out of it. But since I retired, I stopped doing it. I can't contribute more. When you go on Medicare, they don't let you contribute to these things, which is unfortunate because I still pay premiums in the Medicare, same situation, but nobody said tax laws necessarily make sense. But I decided not to use mine and just continue to let it grow. And I have it conservatively invested so that it should grow over time, so that, end-of-life health care sometimes is when we have the most. And so I'm just saving it because I think it's just a better way to use these dollars. So my guess is most of you all, just a second, will be in a high deductible plan. These things are great to take advantage of. Yes?
So is the health savings account like another 401k then?
Yeah, it's very much like a 401k. As a matter of fact, if you never use it for healthcare expenses, you can use it for retirement expenses. It just that if you use it for retirement expenses, you have to pay taxes. But that's the same as a retirement account anyway. So you don't lose anything. That's why my colleagues, I probably should have listened to them, were using it. And I'm sure they've socked away a lot more money in these things. Yes?
You said retirement expenses. What do you mean by that exactly?
Okay, I'm sorry, but give me a little
No,
more.
in your last sentence, you had said you can use your health savings account for
Okay,
retirement expenses.
just like
What do
you,
you mean by that?
okay, well, you put money into a 401k for your future retirement expenses, and it's tax-deferred money, it's not tax-free money. So you put money into a retirement account, and it grows tax-deferred. When you pull it out of the account, you have to pay taxes at that time, okay? Where a health savings account, if you use it, and a flex savings account, when you use those dollars are never taxed, okay? And so that was the purpose of a health savings account. But if for some reason you never need it for medical expenses, you can use it for retirement. You just have to pay the taxes on it, just like you would any other retirement. Does that make sense? That was
Yeah,
actually-
but I'm talking about the end of your sentence there. So when you use it in retirement, are you being taxed on that because you're now using it for a non-health related expense?
Well, in my case, I'm gonna wait till I have the health expenses and I'll use it for that. But what I'm saying, if I don't, I can still use it for retirement expenses. You don't lose it,
Right, but what do you mean by retirement expenses?
like living.
Oh, so any just general cost of living?
Yeah,
Okay.
just any retirement savings when, right now, I have no income other than what VCU is paying me to teach one class, and that'll get me not very far. But what I've done, I've accumulated a lot of dollars in retirement accounts, and so I pull money out of those and use that, but I have to pay tax. So those are good questions. Anybody else? Okay, oh, yes.
I have a question about the retirement savings plan contributions for the $19,000 in 2018.
Mm-hmm.
Is that the maximum contribution of what you're contributing as well as your employer, or is that the individual?
Did you hear a question in the back? The $19,000 contribution for 2019, does that include just your contribution or yours and your employer's? It is just your contribution. So your employer can contribute anything that they want to. I mean, they have some guidelines in terms of what they can do. And by the way, I didn't put it up here because it didn't impact you. If you're over 50, you can add 6,000 to that. They call it a catch-up provision. So, but I don't see anybody other than myself fit that category. Yes?
So for the FSA and the HSA, are they mutually exclusive? Since the FSA, like you said, you can only use it within a little over a year. Can you have HSA as well?
Okay, I was just going to cover that. That's a good question. She asked me if the FSA and the HSA are mutually exclusive. And the answer to that question is kind of yes and no. Generally, you're not supposed to have both. You can have one or the other. However, they call a limited use plan. And by the way, this is where a company is really on top of their game and they really understand the tax laws. A limited use, if a company has a health savings account and they also want to have a flex spending account, they could create a flex spending account and make it limited use. And by limited use, you can't have an expense that you could deduct in each one. So you could have a limited use by saying, well, we're not going to let you do healthcare costs. We're only going to let you do childcare costs. Does anybody have children? Okay. How much will $2,700 count for childcare costs? You can blow through that just with childcare costs. So if the company sets up a limited use, then you can actually contribute both of them. All your health comes out of the health savings. All your childcare comes out of flex spending, and depending on, that's the general answer. There's some specific. That's another good question. Yes.
Are there other ways to put into your retirement if you're not employed by an employer? Like if you just have savings and you want to put it somewhere?
The question is, are there other ways if you don't have an employer? And the answer is yes. You can put up to either $5,000 or $6,000 into an IRA.
And is that tax deductible?
Yes, it can be tax deductible, or it can be non-tax deductible. Okay, and here's the difference. Has anybody heard the term a Roth IRA? There's also such a thing as a Roth 401k. I wasn't going to cover this, but since you asked the question, I will. The difference is they're opposite. When you contribute to an IRA and you're not employed, or you are employed but your company doesn't have a retirement account, then you can deduct the IRA off your taxes. Just like when money goes into the retirement savings account, it's not taxed. Okay? Okay. Now, a Roth IRA is exactly the opposite. When you contribute into a Roth IRA, you do not get a current tax deduction, but the money comes out tax-free. Okay, and I can tell you, unfortunately, I was self-employed, and the Roth IRAs have been around a while, but if your income's over a certain level, they don't let you contribute to them. So I've been very limited of what I could accumulate in a Roth IRA. But the whole idea of a Roth 401k, where people has been around, I don't know, 5, 6, 7 years. So you can choose whether or not your money should go in on a Roth or on a regular tax deduction. And I can tell you, my 2 sons, both are doing well for themselves. One's in his 40s, the other's in his 30s. Both of them have chosen to give up the current tax deduction now for the benefit of never having those dollars taxed in the future. So all their contributions are going into a Roth IRA. By the way, I'm also doing that with since I haven't been able to contribute much because there were just limits, because they were generally, I was just doing better than what they would allow. But now that I'm only making what my salary is for teaching one class, I'm able to put that into actually it's a Roth 403B, I think at the time. So over the years, I'll be able to put a little bit more into it. But when it comes down to it, if you're going to end up as a higher income person, you need to really think hard about putting money into things such as Roth, where you pay the tax now, you let it grow over the years for a long period of time, and you not tax when it comes out. Yes?